Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Not-for-Profit Accounting and Auditing Fall Update. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to introduce today's presenters, Matt Parsons and Scott Simpson, both partners here at Moss Adams. Their bios and contact information are located in your webcast console if you would like more information. And now I would like to turn the floor over to Scott to get the presentation started. Scott?
All right, thanks, Amy. Well, welcome. We're glad to have you join us today for this Not-for-Profit Accounting and Auditing Update. I'm Scott Simpson, and with me today we have Matt Parsons. We are both partners in our not-for-profit practice. We focus on a whole host of not-for-profits, from social service and welfare organizations, associations, foundations, public service, and then Matt and I also do a fair amount of not-for-profit higher education institutions and also some research organizations as well. So a lot of experience in the not-for-profit practice. Coincidentally, Matt and I did this presentation 2 years ago, almost to the date, the Fall Not-for-Profit Accounting and Auditing Update in 2019. So Matt and I are well versed in doing these and are glad to be back presenting to you once again. So our agenda today, learn about recently issued accounting standards and then noteworthy items impacting your audits. I'm going to talk a little bit about some common COVID funding sources and the accounting treatment for those sources. Spend a little bit of time talking about some new auditing standards that have come out and how those are going to be reflected in your reports going forward. And then at the end, we're going to discuss some accounting industry updates, essentially. What's going on in the accounting industry and things that are impacting you. So learning objectives, we have to have learning objectives to get CPE. So identify changes to financial reporting and disclosures resulting from any kind of new standards, applying accounting treatments for COVID funding sources into that, and then just some best practices in your industry, whether it's communication with boards or issues that you're dealing with, and some potential solutions. So with that, we're going to jump into some new accounting standards. So far in 2021, there have been 8 accounting standard updates issued by the FASB. Those are referred to as ASUs. And today we're going to talk about 3 of those. Actually, we're going to talk about 2 of those, but there's 3 of these new ones that issued in 2021 that impact or could impact not-for-profits. There's a whole host of them that have been issued in 2021 that just don't apply. So stock compensation, earnings per share, revenue from contracts with customers for franchisors, business combinations, a lot of those just don't apply. And so we're going to try and focus in on those that do apply. There is one on leases, certain leases with variable lease payments. This is ASU 2021-05. We're not going to talk about this. We're not sure the impact that this will have across the not-for-profit industry, so we're not going to discuss that one today. But the first one we are going to discuss, and this is one that probably will impact a lot of you, is ASU 2020-07, and this is presentation and disclosures by not-for-profit entities for contributed non-financial assets. This was issued in September of 2020, and it's effective for fiscal years beginning after June 15th, 2021. So this is really a June 30, 2022 and thereafter kind of fiscal year end. So there is a new requirement for separate line item disclosure in the statement of activities. And you can see on the slide here that in-kind contributions, that $12,000 line item for without donor restrictions, $3,000 with donor restrictions, for a total of $15,000. Sometimes with certain nonprofits in the past, this has been lumped together in contributions, but the FASB wanted to make the financial reporting more transparent of contributed non-financial assets, so they are requiring that this be broken out. So this is the display on the statement of activities. And then there are disclosure requirements. So the disclosure requirements, the qualitative information on whether the contributed non-financial assets, whether they were monetized or utilized. So monetized is that if there's a policy where you receive something and you immediately sell it, that would be the monetization. And then description of any donor-imposed restrictions. We have an example of this on the next slide here in a moment. And then description of valuation techniques. So let's look at what a disclosure might look like. Next slide. So it might be a little hard to see, but you can, this is how it is broken out, this example disclosure. So equipment was donated. That equipment had had a fair value of $10,000. There were no donor restrictions. Fair value techniques, so how did they come up with the $10,000 estimated wholesale price of identical or similar products if purchased? You can see there the food and legal services are 2 other examples of non-financial assets. And then it also discloses the usage in what programs or activities. The other piece that I didn't get a chance to include here in this slide would be an example of a monetized disclosure. And that would be, say, a vehicle was donated, and that vehicle had a fair value of $15,000. What you would disclose is that it's the policy of the organization to sell contributed vehicles immediately upon receipt, unless the vehicle is restricted for a specific purpose or program by the donor. So an example of that is maybe a commuter van to be used to provide transportation for recipients of the not-for-profit's mission. That might be an example of a monetized non-financial asset and how what the policy is to monetize it. So that's ASU 2007. On to the next ASU. Oh, nope. First, we have a polling question. So, Amy, I'm going to turn it over to you for the polling question.
All right, thank you. So our first polling question, does your organization currently have goodwill recorded on your statement of financial position? A, yes, B, no, or C, unsure. And we will give you a few moments to respond. In order to respond, you will need to click the button next to the answer you choose and hit submit. And if you cannot see the submit button, you will just need to enlarge the slide area so that you can see it.
Hey, Sky, I know there was one question that came up in the chat regarding the presentation of those in-kind contributions in the statement, the face of the financial statements versus the footnotes. Just to answer the question, there is technically a requirement in the new standards that says it should be broken out on the statement of activities. But of course, I'd say materiality always comes into play and should be considered when thinking about that presentation. But there is a specific requirement in the standard that requires it to be separated out.
Thanks, Matt. That's a great point. And yes, there is that requirement in there. So we're going to give a few more moments here for the. Go ahead, Amy.
I was going to say, it looks like most people have responded, so I'm going to pull up the results here.
All right. This is about what I would expect. We don't see a lot of goodwill in our not-for-profits, but we do see some. So about just shy of 15% is probably what I experience in my client base that I work with that do have goodwill. All right. We'll move forward. So this, our next ASU is reference rate reform. This ASU was issued in 2020, in March 2020, and it was again updated or revised in January of 2021. So who does this impact? Organizations with swaps, derivatives, or debt that references the LIBOR rate. And why this is important is LIBOR is being phased out, and many debt agreements along with swaps or other derivatives reference that LIBOR rate within the swap. It applies to contract modifications, and they're very specific here. Between March 12, 2020 and before December 31, 2022. And so if your organization has an agreement with LIBOR and you are updating it to an alternative rate, this ASU would apply to you. And it's important because if the criteria are met, you would not have to apply contract modification accounting. So really important to go through your contracts, your debt agreements, if you have swaps. If there's a LIBOR rate reference, it's probably going to need to be updated. So pay attention to this accounting standards update. The next one we'll talk about, and the last new accounting standards update that we'll cover was issued in March 2021, and this is for intangibles, goodwill, and other. So this allows not-for-profits that do not already amortize goodwill the alternative to evaluating impairment triggering events at the end of a reporting period rather than when the triggering event occurs. So many not-for-profits during COVID had difficulty in identifying a triggering event because the uncertainty in markets and the economy, where things were changing so fast, expected. Some entities were really preparing for the worst in March and April of 2020, only to have their best year ever in 2020, where others thought they maybe could ride it out, and turns out that they had a steady decline the entire year. So now not-for-profit entities can evaluate impairment triggering events at the end of a reporting period with the added benefit of kind of some hindsight or look back. Prior to this ASU being issued, you essentially had to identify the triggering event when it occurred and apply the accounting, really the accounting for impairment when that triggering event occurred. And that was causing problems. So they allowed you to have more of a look back on this situation. Again, it doesn't apply to a lot of the people on the call here, but those that do have goodwill, this is something that's important to pay attention to. Okay, move forward. Accounting for COVID relief. So today we're going to focus on really the three areas you see on the slide: employee retention credit, PPP loan and forgiveness, and then shuttered venue operating grant. There's a lot of other COVID relief that applies to nonprofits out there. HERF for higher education institutions, PRF for healthcare entities or healthcare related entities. But today we're just going to focus on three, and those are, as you see on the slide in front of you. There really have been six, I'll call it major or significant acts of Congress that have provided COVID relief, starting with the Coronavirus Preparedness and Response Act, issued in March of 2020. That put forth $8.3 billion, followed by the Families First Coronavirus Response Act, $225 billion. The CARES Act in March of 2020, $2.2 trillion. Paycheck Protection Program and Healthcare Enhancement Act, $483 billion. The Consolidated Appropriations Act, that was $920 billion, and then the American Rescue and Recovery Plan, $1.9 trillion. So all in all, there was $5.3 trillion put forth into the economy through COVID relief acts. So let's start with employee retention credit. So the original employee retention credit came through the CARES Act. It was modified in the Consolidated Appropriations Act. And you can see here the slide goes through eligibility and then threshold for determining qualified wages. So this credit will be applied against the employer's share of Medicare taxes instead of Social Security taxes. That's for the revised 2021 Act. And then prior to that, the first portion, the 2020, was Social Security. So employers who had fully or partially suspended businesses or operations due to emergency orders were allowed to participate in this, and they had to have had at least a 50% reduction in gross receipts. This is for calendar year 2020. In 2021, they reduced it to 20% reduction in gross receipts. 100 or fewer employees for the 2020, and then that was up to 500 or fewer in the revised Consolidated Appropriations Act. Next slide here, how to calculate the credit. So we're talking about qualified wages. So the credit is equal to 50% of qualified wages. Those wages can be up to a total of $10,000 for all quarters per employee. So that's important. And then the credit may be worth up to $5,000 per eligible employee in 2020. That gets up to $28,000 per eligible employee in 2021. So this program was great for a lot of smaller not-for-profits. If they took advantage of it, it amounted to real savings for them. So
Scott, I'm not sure if we lost you or not.
sorry about that. Thanks, Matt. Okay, just restart here the slide. The Employee Retention Credit Accounting Treatment. So although labeled as a credit, the reduction of payroll taxes, it's just the mechanism. So you would report the full expense of the FICA credit or the FICA taxes on your statement of activities, and then the credit would be recorded as grant revenue. So grant revenue, and it's important to know that this is not something that would go on the schedule of expenditures of federal awards. So this is not considered a federal award, even though it is coming through the federal government, similar to, and we'll talk about in just a second, the PPP loans. So the Employer Retention Credit, great program, and benefited a lot of not-for-profits. We are now going to move to our next polling question. Amy?
All right, thank you. So our next polling question is, did your organization apply for and receive a PPP loan? A, yes, B, no, or C, unsure. And also as a reminder, if you would like to receive CPE for today's webcast, you will need to respond to at least 3 of the 4 polling questions.
Scott, I was going to mention, I heard from our tax friends that when preparing 990s, not be surprised that I believe the employee retention credit actually is a reduction of expenses. So there is that one reconciling difference between how you present the grant revenue on the financial statements as opposed to how you'll present it on your 990. Just a little plug for them.
Good. There's a lot of there can be a lot of complications with some of this stuff. It seems like the guidance is changing or guidance is not coming out fast enough. So it's important to hear these kind of feedback.
Exactly.
All right, well, here are the results to the second polling question.
All right, so a little over about almost half received a PPP loan and about half did not. I know that some of the larger nonprofits that I work with did not apply because they were not scoped in, had too many employees to actually qualify for the PPP. All right. We will move into accounting treatment for PPP loans. So the PPP program, total amount was about $950 billion nationwide. The program ended May 31st, 2021, but many still may be working on debt forgiveness or obtaining the forgiveness. So that's why we're trying to go through this today. We're going to go over 2 different scenarios for how this could be treated. The first is debt. So you would initially record as debt on your statement of cash flows if it crossed year end. We recorded as cash flows from financing activities. There could be a breakout between short-term versus long-term. I know I had this discussion with several not-for-profits that were expecting to receive full forgiveness, so they chose not to break that out, short-term versus long-term. We recognize the liability upon forgiveness and record it as a gain on forgiveness in the statement of activities. So initially, just the debits and credit, you debit cash, you credit PPP loan, so an asset liability, and upon forgiveness, you would debit the PPP loan and credit revenue for gain on forgiveness of debt. So pretty straightforward on this one. The other accounting treatment would be the kind of the grant revenue option. So you would initially record it as a conditional contribution and initially record it as a refundable advance on the liability side. You would recognize once that there is no longer a barrier to right of repayment, so this is the forgiveness, and there would be no cash flow statement impact as no reconciliation would be necessary, be flowing through operations. This is what I've seen a lot of not-for-profits use over the last 9 months. I would say the first, the last 6 months of 2020, I did see quite a few go the debt route, but it seems like a lot have chosen to go this grant revenue route in 2021. Finally, it's important to know that PPP loans do not go on the CFA. So these are not considered federal awards for the purposes of a single audit. Last item we're going to cover is Shuttered Venue Operators Grant. This is part of the Consolidated Appropriations Act. There was $16 billion that was allocated to this program. And as you can see here, the different types of entities that most likely were to be able to receive Shuttered Venue Operators grants. Within our client base, it's probably going to be mostly museums, zoos, aquariums, those types of organizations. And so with Shuttered Venue Operators grants, this is something that is included on the CFA and can be counted towards federal awards in determining applicability of a single audit. So this could kick an aquarium, a museum that maybe hadn't received federal funds in the past. They get a good chunk from this. This could kick in a single audit. It's recorded as grant revenue, and there is no offset against expenses, and you base it off of the eligible expenses. So you can see the eligible expenses, and then you can see their types of expenses that would not be eligible, determining whether you were able to meet that. And I'm going to go back a slide here. You were able to meet that qualification. So with this, I can tell you that personally, I haven't seen many of these grants flow through in just the organizations that I work with. Matt, not sure if you've seen this or not.
Yeah, I'm starting to see more of it. I think a lot of the funding started to be trickling out in April, May of this year, and so it hasn't really affected our junior end clients, but we're getting a lot of questions about it. I know there's not a lot of guidance that's been issued by the OMB yet on actually how to test these funds, so we're waiting, just like everyone else is, for some additional guidance to be able to complete some of the single audits for any organizations that did receive these awards. Some of them do allow for retroactive expenses to be covered. So if you received it, say in May or June, and are applying expenses that occurred, way before the time of the award, there might be a delay in your single audit if it's over the threshold. So just a couple of, things to sort of hold on and wait to see what happens.
Great. So more to potentially come on this, especially as OMB puts out guidance. And with that,
Exactly.
I think, Matt, I'm turning it over to you at this point to move into some of the auditing side topics.
Perfect. Thanks so much, Scott. So as part of our update, we thought we would touch upon some, what we think are actually pretty significant changes to the auditing standards that are the result of a new suite of reporting standards issued by the AICPA, or American Institute of CPAs. The most significant impact is the pretty dramatic change in the format of the audit report or the opinion itself. I know you're all probably thinking, isn't this your job to know about the standards, not me? I would say that's true, but some of these are pretty significant, and we thought it would be important for you to be aware of how they might impact your organization. We think this will actually especially be helpful for you, too, if you're reviewing other financial statements, maybe for an alternative fund financial statements that you receive, or maybe a subrecipient that you pass through funding to, that you're doing some due diligence review on, just so that you're not caught off guard and aren't surprised by any of these updates. So with that, we'll dig in. First, it should be noted that the AICPA standards do vary from PCAOB standards, which apply to public companies. Auditors applying PCAOB standards have been operating under similar formatting changes for a while now. There are new standards that also touch upon how an auditor reports, how to address the supplementary information and going concern, which we'll touch on a little bit later. There are several other areas that the standards have impacted, including materiality, information that we as auditors need to relay to those charged with governance as well. One thing to note is that these standards are not new in the sense of issuance. The original standards were actually released back in May of 2019 and could have been applied to reports on financial statements as early as December 31st, 2020. However, due to COVID, a deferral was issued by the AICPA to begin with all reports on financial statements for the year ending December 31st, 2021 and after. And each firm or practitioner had some leeway on adoption, so you might be an organization that already have adopted this, but many firms did elect to defer to see if additional guidance came through, and so we'll start to see these new formats pretty soon. Note that the use of the new reporting format has no bearing on when the audit report is actually issued. It has strictly to do with when the financial statement year end is. So if you're a June 2021 year end and don't issue until January of 2022, this still will have no impact to you. It will only be for December year ends and after. And with that, we're going to dive into a new polling question. Amy?
All right, thank you. The third polling question. Of the following, which was the hardest thing for your organization to cope with during the pandemic? A, transitioning to remote working. B, reduction in revenues impacting operations. C, loss of employees. Or D, testing, contact tracing. And I also want to let you know, we've had quite a few people ask if the webcast is being recorded, and the answer is yes. We will be sending a recording of the webcast via email tomorrow, along with a copy of the slides.
Matt, I think we should have had another answer up here, which is E, all of the above.
Definitely, definitely.
All right, here are the results.
Great. Yeah, big mix. And not surprising too, right, Scott? Just seeing everyone's had at least one or two of these impact their organization, and it feels like it's not over yet. We just continue to hit new curveball after new curveball.
Exactly.
All right. Awesome. So let's look into the more significant impacts of these standards, and we'll start with SAS 134. This is the largest of the new standards, and this has the main changes that will be really visible to most of you. It relates to the form and content of the actual audit report. So the opinion paragraph is actually going to move to the very front of the report. Historically, it's been towards the end of the report, and sometimes that means you would have to go to the second page, depending on the font size of your firm, until you actually see where that opinion is. And this is the most important part of the report, and we don't want it to be hard to find. So the AICPA felt that it would benefit users the most by making the opinion paragraph more visible by starting off every report with it. Then directly after that will be a paragraph explaining the basis that the auditor used to come to that conclusion. That basis for opinion section is actually pretty different from what we're used to. Under the current standards, an auditor would only report a basis of their opinion if there was some form of modification to the opinion. So now that basis language will show up even if the opinion is unmodified, which means a clean report. There's also going to be some enhanced reporting related to going concern. It will include language regarding management of the entity's responsibility related to evaluating going concern, as well as the auditor's responsibility related to going concern. It should be noted that this new going concern evaluation language will be in the report regardless of whether there is a going concern expressed. The current version of the audit report is really silent on this in the present time, so this will be a pretty significant change. And really the reason for this change is to confirm Accounting Standards Update 2014-15, when that onus of determining when and how to disclose a going concern became a requirement of management and not just the auditors. I'm guessing most of you right now have been asked by your auditors to document an assessment throughout the year end and at the end of the year. And so this new language is really referring to that requirement. The report is also going to define what a reasonable assurance is, and it's going to define what a material misstatement is. And in fact, under SAS 138, the definition of a material misstatement will be slightly amended. It will also describe when auditors are required to communicate with those charged with governance. So, your board isn't left wondering if something has been omitted as part of those communications. There'll be some bullet points in the opinion that will specifically state what's required, and your board can refer to that as well when they're going through their presentation or review of that letter that might come from your auditors. It will also make it the distinction that the risk of detecting material misstatement resulting from fraud is greater than one resulting from an error. And then finally, it's going to include some language about the auditor's responsibility to be independent of the client. However, it won't positively affirm that an auditor actually is independent. And the reason for that is because in situations of an adverse or withdrawal of that report, you can't necessarily confirm independence in that case if it has been impaired. All right, so this graphic is just trying to show in order here how the new report is going to look compared to the past report layout. We'll see the first bullet here is the title of the report is changing slightly. So for those entities that draft your own financial statements and put together your own table of contents, you'll want to make sure your reference is updated here. Also, many of these reports will probably be longer than they have been in the past and result in an extra page to the standard opinion. So your numbering is probably going to be adjusted. For those of you that really like your, statement of financial position to be page 2 or page 3, there might be a shift there. So just a heads up. The other thing to note is that if there is an emphasis of matter paragraph added in, such as for the adoption of a new accounting standard or a reference to a particular footnote or to talk about a restatement, that is no longer required to follow the opinion paragraph directly. It can, but there's more judgment permitted to the auditor based on sort of the significance and context of that information. And at the bottom of this new report layout column, you'll note in red a report on other legal regulatory comments. That's highlighted in red because it won't apply to all entities. One example where this paragraph might be required is if your audit is conducted with government auditing standards and your auditor has to issue a report on internal control over financial reporting and in compliance with laws or other regulations such as a contractor grant agreement. The most significant change to the communications with those charged with governance is the requirement to report on significant risks identified by the auditor. Although many auditors and firms were previously reporting on significant audit areas identified in the audit, it wasn't always consistent because it wasn't a specific requirement. Now the auditor will actually be required to disclose that to your board. The basis for when an auditor determines a report should be modified has not changed. As a reminder, a report modification would include an adverse opinion or some type of disclaimer opinion. And then lastly, we're going to talk a little about CAMs, or Key Audit Matters. I want to point and focus on the K here, not to be confused with CAMs that we see in lease arrangements for common area maintenance charges. And more importantly, not to be confused with critical audit matters, or CAMs that are currently required by PCOB or those public companies. In theory, critical audit matters are really the same premise as key audit matters. The difference just relates to the accounting body that created them. An example of a key audit matter might be related to, say, a significant estimate that was made in preparing the financial statements, and then the auditor would include the procedures that were performed related to the testing and evaluating of that estimate. What's really important, and I want to stress that really important, is that CAMs are not required to be included in a report and would only be included if you engaged your auditor specifically to provide this additional information. So, we expect this to probably be pretty rare for our not-for-profit industries. So another item is SAS 134. There are some amendments that were introduced to increase the auditor's focus on financial statement disclosures throughout the audit process. There were some minor shifts that are probably being done in practice already, since we know that many disclosures have evolved from sources of certain documents that are outside of the GL or general ledger. For example, how many new disclosures have been added related to revenue recognition, which require an auditor's understanding of customer contracts, or reviewing of leasing documents to fulfill some of these new lease disclosures. This guidance will require the auditors, as part of their risk assessment process, to really think about where could there be a material misstatement in a footnote disclosure stemming from these contracts, agreements, and other source documents that are used to prepare the disclosures that are outside of a GL transaction. Again, most auditors are doing this already to some degree, but we wanted you to be aware of it because it may require some additional support or questions individuals outside the accounting department for them to get comfortable with the completeness and the accuracy of the information and these external documents that feed into these footnote disclosures. Audit standards have always been required to auditors to reconcile the financial statements to underlying accounting records, but now AUC 330 takes a step further to explicitly require the same detail of reconciliation and support to disclosures that might not solely be based on the general ledger. As I mentioned earlier, there are no changes on the accounting side or the auditing side, for that matter, when it comes to responsibilities for evaluating going concern. What has changed is that if there is a substantial doubt that remains after considering management's plan to relieve substantial doubt, there will be a separate section in the auditor's report with this heading, which will immediately follow the basis of your opinion paragraph. Even if substantial doubt is alleviated after considering all of management's plans, the auditor still has the option to include an emphasis of matter paragraph, similar to what we see in current standards. But of course, that would only apply if you as management have included sufficient disclosures for the emphasis of matter to refer to. If the auditor feels that the footnote disclosures do not adequately disclose the circumstances or that they are materially misstated, the auditor would still need to think about maybe a qualified or adverse opinion. But regardless, as mentioned earlier, even every report now will have some discussion about management and the auditor's responsibility when it comes to going concern. So moving down through the SASs, SAS 135 is an omnibus standard. I just love that word. Or a catch-up or cleanup for past standards. There are really small new requirements or wording changes for related party transactions or transactions outside of the normal course of business. It requires us as auditors to evaluate related party transactions even more closely than we have in the past. A few highlights in AUC Section 260 is that there is a requirement for auditor communications to those charged with governance to communicate that the auditor's views on significant unusual transactions and the potential effects of uncorrected misstatements on future period financial statements. So, I think many non-financially literate board members have really had trouble grasping when there is a past adjustment, what that really means. And in theory, if there is a substantial past adjustment that really continues to be carried forward year after year, it could accumulate into a material misstatement in the future, and that could result in a restatement or possibly a covenant violation in the future. And so it's not trying to dissuade management from the decision to pass on adjustment that's not material, but really simply to give, again, the board or audit committee members that proper context of what a past adjustment means. The other minor changes simply reflect some enhanced inquiries for related party transactions, and then some of the significant transactions that you might see some auditor template changes in the request list that get updated to reflect these required inquiries. For those of you that work with your auditors on a benefit plan engagement, you may be familiar that frequently auditors engage in what we call a limited scope audit, meaning that technically there was a disclaimer by the auditor over the investments if they were managed by a qualified institution. That limited scope language is no longer going to be applicable. It's been replaced with this ERISA Section 103A3C audit section, really kind of rolls off the tongue in the report. It's still the same premise though. Management can elect under CFR 29 that the auditor perform more limited test work as a result, which I think most of us realize helps keep the fees for these audits down lower than they would be otherwise. So auditors now will actually be providing an opinion on the financials. They're just simply caveating the scoping if they don't do formal testing over these assets. It seems like the old language was really confusing to some of the readers of financials, and they didn't like that terminology, limited scope. I'm not really sure that this new language is necessarily less confusing, but certainly it doesn't sound so damaging, so it's what we've been given. All the other reporting changes will mirror SAS 134, like we talked about earlier, with the exception of this ERISA language that will precede the opinion. SAS 137 is a bit of a turn. We're now going to get into other information. This standard outlines the scope of documents related to other information that auditors might need to perform procedures on that's outside of the traditional financial statements. So starting with a couple of definitions to help us level set what is other information. This has been defined as financial or non-financial information included in an entity's annual report. Note that we're talking about not the financial statements here, but an annual report that, say, a management might produce for donors or funders. Other information is not the same thing as supplementary information, such as a consolidating schedule or the CFA. It really only refers to other information that is not necessarily even tied into the financial statements. So coming down, we see that the definition of annual report, so it's a document or combination of documents typically prepared on an annual basis by management or those charged with governance for the purpose of providing additional information to stakeholders. I know you all can read it, but I'd just like to read it in case because there are some nuances here. So this would include annual reports of governments and organizations for charitable or philanthropic purposes that are available to the public. So please note that just because it refers to the term annual doesn't mean that it has to be performed on an annual basis. I know some organizations like foundations I work with and other nonprofits that really only issue maybe an annual report when they're embarking on some kind of campaign or trying to reach out to new donors. That doesn't mean it isn't an annual report for this purpose. So if it's only done, say, every couple of years, it still probably would fall under this definition. The most key part of this definition, and I probably should have bolded it, is that it contains a company or organization's incorporates their reference to the financial statements and the auditor's report. So again, if you're producing an annual report that talks about nothing related to the audit, just has no financial information in it, then you're probably fine. But if you do, say, include subsets of the statements or refer to the fact that information in the report came from an audit, then that's where this is really referring to. One thing to note, something that many of these characteristics have, but but it's not really considered an annual report. Would be something like a preliminary official statement or an official statement for a bond offering. While it does include the financial statements frequently, it's not prepared on a regular basis, and it actually falls under other audit standards already. But I just thought this is probably a good time to plug that if you do go through a public bond offering, it's really important to loop in your auditors early in that process, as frequently there's some additional procedures that they need to perform in preparation, especially if their name is going to be referenced at all in that document. So what does this mean for you and your organization? Really, it's important to have conversations with your auditors if you're planning to issue an annual report or have recently issued one. The auditor then has an obligation to reference what responsibility they might have related to those reports in their engagement letters. So if we go to the next slide, we'll talk about what the auditor needs to do. So if your management team has a draft of this annual report prepared before the financial statements are issued, the auditor is required to document some procedures over that information, such as reading it and looking for material inconsistencies. And then they probably include some additional representations in the rep letter that would regards those procedures that are being performed. But I think most commonly we see that these probably won't be drafted at the same time in the financial statements. So what do you do in that case? Many of the procedures the auditor will have to do will be the same. You'll still be asked to share a draft of the report before you issue it, so that your auditors can review for potentially those material inconsistencies. If your auditor has already issued the report on the financial statements, this will not require them to reissue or restate the report in any way. And auditors are not required to update subsequent events in these cases because the auditors aren't issuing any kind of consent letter to include the annual report. But hopefully, though, you'll communicate earlier on that a report is coming and include so that they can include representations acknowledging what those procedures will be once that draft is available. All right. I know we've spent quite a bit of time under the assumption that your organization is being audited. In some cases, you might be engaging an accountant to conduct a review. Well, don't think you've gotten off completely free. There are some new standards effective for accountants conducting a review as well. The primary change here is SARS 25, which requires an accountant to establish materiality. Historically, the standards require organizations to report material disclosures and ensure that financial statements were not materially misstated, but they didn't specifically state for accountants to necessarily establish like a materiality benchmark when they were conducting the review. And as a result, under prior guidance, an accountant could only withdraw from an engagement if he felt there was a material misstatement that couldn't be resolved. So now there is new report language that's been drafted that allows those accountants to actually issue, say, an adverse report similar to an audit if they just cannot get over the hump of a material account. And the standard also requires that the accountant's report highlight independence and ethical responsibilities of the accountant. And this will apply for financial statements for years ending this December and later. All right, and we're running out of time, so our last polling question.
All right, thank you. So our last question is your organization considering or implementing hybrid work options for some employees or departments? A, yes, B, no, or C, still discussing this topic? And then also, once you've completed all CPE requirements, you can download a PDF of your certificate from the CPE progress window. And then also, as a reminder, if you attended today's presentation in a group and want to receive CPE credit, you will need to complete the group attendance sheet that's found in your console.
I just want to say, I know since we're running a little short on time, there's a few questions in the queue. We'll definitely reach out after the presentation to respond to those questions so you don't get left stranded.
All right, here are the results.
Great, thanks, Amy. All right, so we just thought we'd touch a little bit about accounting industry updates, what we're seeing in practice. Scott and I thought it'd be prudent to comment, on some of the trends we're seeing with the accounting industry, and we're probably all experiencing the same thing. And some of the impacts this might have on internal controls, competencies, and training of our teams. So, it feels like more than ever we're seeing really strong competition for talent in the accounting space. So whether that is because of retirements that might have been escalated in their timeline, because of the pandemic, or people are just growing tired of the profession, they're trying something new, these vacancies are certainly leading to quite a few capacity constraints. We're also noticing that these constraints are resulting in pretty significant salary increases for the profession that are even outpacing other inflation rates. And so sometimes it's hard just to have the budget capacity to fill in some of these gaps. And the demand for this sort of permanent workplace flexibility has increased capacity in some sectors, but for some responsibilities, that are more efficiently done from a central office has really led to some significant holes in those positions. So, all that being said, we just want to encourage all of you to, really revisit your policies and procedures, rethink any holes that might have been caused from any of these factors, and update some existing policies to reflect maybe some new practices that have been developed as a result. Scott and I have also both noticed there's quite a few experienced for-profit professionals that are moving into the not-for-profit sector. And with that, some general not-for-profit accounting, understanding might have been, lost in that transition. And so it might be some time now to dust off some, NFP 101 accounting books, or refer to the talent in the workforce to some of these accounting concepts that might differ from, the commercial corporations. I know we have a lot of on-demand webcasts that are available, as well as many other sources that you can maybe refer them to get up to speed on some of these, longer-term concepts. But these include how to properly account for endowments. Disclosures for endowments can be quite extensive, and tracking related assets and accumulated earnings that are measured against the original corpus of these gifts is a challenging topic to get familiar with. I'm sure you've heard a lot about the great wealth shift that has already started in the U.S., and the number of donors that are starting to establish split interest type arrangements seems to definitely be on the rise. So does your team have the resources and the templates to account for these properly? Same with pledges. We're seeing organizations are really struggling with some of the concepts around net present value discounting and how to determine what the discount rate is for these gifts. And we're just seeing in general some more complex type of gift arrangements occurring. Finally, our observation has been that more and more nonprofits are soliciting the help of third-party or outsourced experts to really backfill these open positions, or because they're finding they're only necessary on a part-time basis. More and more organizations are outsourcing back office accounting and payroll, and while it's efficient, sometimes it's important that your entity has put into place some appropriate safeguards to really prevent the theft or data loss that could result. Many outsourced market-based solutions have internal control audits, and they're obligated to share that with you. So it's important that you're asking for these on your own accord, not just when your auditor might request that from you, and that you're actually taking the time to look through any deficiencies in controls that might have been identified as part of those audits to give you the comfort that you need. And then very last, we just thought we'd put a plug in for some keys for successful audits. A lot of this information will be helpful to pass through to your boards. Don't feel shy. Ask your auditors for assistance, and maybe reaching out more than just during traditional audit time to explain some of these implications. Communication is key, and we again know that everyone is sort of resource tapped. So really think through the audit timing of what's going to be the most efficient. When are we really going to have those schedules prepared? Are there questions that can be handled that have field work that will take off some of the pressure of when those traditional testing periods will be? And just in general, reach out and ask questions. That's what we're here for. Scott, any other closing remarks or things that you can think of that you wanted to touch before we close?
I would just say that I've seen a lot of organizations engage their board and their audit committee during this time of COVID, much more so than they had in the past. And that's, talking about audit timing, audit preparation, just general discussions. I think that's proved really valuable for those organizations. So now more than ever, make sure you're in touch with your board on a regular basis, informing them on things that are going on. I'm sure a lot of you already are doing that, but just take the time to think, is there something else that you can be doing that would help them out? Because those relationships, when strong, are so invaluable.
Thanks, Scott. All right, Amy, you want to take us home?
All right, yeah, so thank you, Matt and Scott, for a great presentation today. And unfortunately, we are out of time and don't have time to answer any more questions from the audience. But as Matt mentioned, we will do our best to follow up with you after the webcast. And if you think of any more questions, feel free to reach out to our presenters as well. And before you go, we always have several resources available on our website. Some of them are already linked for you in your console, so definitely check those out. And I'll keep the console open for a few minutes to give you time to download your CPE certificate. And a copy will be emailed within 3 weeks should you have any difficulty downloading it now. And finally, here's a link to an online survey for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. And thank you for joining our webcast. Take care, everyone.
Thanks all. Bye.